a comprehensive look at trends, fund profiles, and more in Exploring ETFs.
Hi everyone, welcome to Exploring ETFs. I'm Neena Mishra, and today we are talking about a new ETF which offers 100% downside protection. That means you cannot lose any money if you invest in this ETF. Sounds too good to be true. Let's see what it does, how it works, and whether investors should invest in this ETF. So just going back a little bit about an intro about buffer ETFs or defined outcome ETFs that we have discussed in the past. So these ETFs allow investors to participate in market upside up to a cap and then limit losses if the market falls. And in case of this particular ETF, there is no loss. And these defined outcome ETFs are one of the fastest growing ETF categories. And Innovator had launched the first buffer ETF in 2018. Currently, Innovator offers more than 100 ETFs with about 15 billion in assets under management. Of these, more than 50 are these buffer ETFs. So this new ETF, it is called the Innovator Equity Defined Protection ETF. Ticker symbol is TJUL. This is the world's first ETF with 100% downside protection. It seeks to track the performance of SPY, S&P 500 ETF, SPY's return with a cap of 16.62% over 2 years. The outcome period is defined. This is the 2-year outcome period. Investors should remember that they forego dividend income. The expense ratio, it's not cheap, 79 basis points. And the ETF has already seen a lot of investor interest, 61 million assets under management currently, though it is a very new ETF. Now, how does this ETF work? So according to the prospectus, 80% of assets will be invested in flexible exchange options. These are customized options. They are also called flex options. Basically, the product will hold 3 types of options. It will buy deep in the money call options, which will provide SPY exposure, and use the implied dividend income to buy at the money put options. Those would provide 100% downside protection, but that is not enough to buy these put options. They need some more money, and to reduce the cost, they also sell some call options, which in turn limit upside returns, so there is a cap. Now, should you buy these ETFs or should you get downside protection? I would say that the product is not suitable for long-term focused investors because over the longer term, stocks go up more often than they go down. So if you're a longer-term focused investors, you should not bother about short-term movements, short-term noise, but stay focused on being invested over the long term. So since SPY ETF launched about 30 years back, as this has produced, the S&P 500 index has produced annualized return of 10.14%. So every year you get more than 10% return on an average. But after last year's market plunge, many investors have a lot of money in cash, a lot of money on sidelines, which is not invested. So if you're one of those investors who are worried about market sell-off and probably you are a risk-averse investor nearing or in retirement or for some other reason, if you don't want to take any risk, then yes, maybe look at this product. Now, again, if you want to get downside protection, there are other ways to get downside protection. A simple strategy is just to invest 90% of your stock portfolio in 2-year treasuries, which we know are yielding close to 5%. So that 91% in 2 years will give you about 100% of your stock portfolio value. So your portfolio is 100% protected. And then 9%, remaining 9%, you can invest in S&P 500 call option, which will go up if the market goes up. So you get some upside, more upside if the market goes up more. Plus you get 100% downside protection. And these type of strategies have been available to investors through fixed income annuities and market-linked CDs, but an ETF wrapper offers several advantages, including more tax efficiency, lower cost, much lower cost in fact. There's no minimum purchase requirement. You get daily pricing and liquidity, and there's no bank credit risk. So if you want to learn more about the ETF, you can go to the code page on Zacks.com, and using the link, you can go to the innovator web page for the CTF. They have a lot of educational material that you should read. You should learn more about the CTF before deciding to invest. And as I mentioned earlier, this outcome is valid only during this outcome period. If you invest on the first day and hold till the last day. If you invest in between, your outcome will be slightly different, and Innovator explains what your outcome will be. So you can take a look at the outcome if you invest in between. Now, they also have these market scenario. So if the market goes down, whatever it goes down, 50%, 100%, anything, you lose nothing because your downside is 100% protected. But if the market goes up, say it goes up 10%, you get 10% upside. If the market goes up more than that, supposing it goes up 20% or 25%, your upside is limited. Over the 2-year period, you will get only 16.6%. That is something you should remember. And these ETFs, these options, the holdings that we discussed earlier, these are the 3 types of options the product invests in. Thanks for watching. Make sure to check out Zacks.com/promo for an interesting offer. Also, make sure to subscribe to all our videos, our video channels, so that you do not miss anything. And I'll see you next week.